Welcome to the ETF Show, taped right here at the New York Stock Exchange. I'm your host, ETF Editor-in-Chief for Asset TV, Kristen Myers. Now, the ETF space has really been exploding with innovation, especially in the income space. So take a listen to this. According to the NASDAQ, of the 1,100 new ETF launches that we saw in 2025, about a quarter of them were those that use options as a core component of the investment strategy. Now, in 2026, options income ETFs have been a leading category, pulling in a notable amount of flows and have grown to well over $100 billion. Here to discuss more is Mike Khouw, Chief Strategist at YieldMax ETFs. Mike, thanks so much for joining us.
Hi, Kristen. Thanks for having me.
So I want to talk a little bit about taking the sort of 10,000-foot view. Volatility has really been the theme, so to speak, of 2026 so far. What do you really see driving that? Is it primarily just U.S.-Iran war, what we've been seeing with inflation, something else? And why do you think that matters so much for the options income space?
Well, I mean, clearly over the course of the last 18 months or so, the current administration, I think we've had a couple geopolitical events which have contributed to volatility. The first was what I call the tariff tantrum. Took place back in April of 2025, actually, I should say. That was last year. And then, of course, the war is highly disruptive. This is the biggest disruption that we've seen to the oil markets in history. And that's going to cause some volatility. But what we're also seeing is that what is motivating equities right now are earnings and results. They've been quite good so far. And so we had that swoon that was basically related to the initial panic about the oil market disruption. And then equities caught a bid on the back of very, very solid earnings results, particularly from those Mag 7 names that have been reporting, in many cases, better than expected. So that's causing stocks to move around. When stocks move around, you get a bigger bid to options because options are a form of insurance on equities. And options income ETFs, which is what we focus on, look to harvest some of that premium for income. And obviously, it's been a good environment for us.
So in your mind, this is the type of environment where you see options income strategies working best.
I think this is a good environment. I also think that just in terms of secular trends, I'm anticipating that the next 5 years are probably going to be better for options income harvesting strategies than the last 5 were. A couple of reasons for that. So the first of these is that, we've gone through a profound bull market. This is all about capital appreciation. We had a very long period of exceptionally low interest rates. I don't think we're going to return to that. In those types of environments, equity appreciation is the key. Now, what are we seeing? Right now, valuations are, I'm not going to say that they're stretched, but they are, fully valued. They're reasonable at this point. So I don't think we can anticipate to see 20% year after year after year. So investors who are looking for total returns that are better than that, and also in a more inflationary environment, sometimes they're looking also for some distributions. You need to use cash for things. Then I think that's probably going to be a better environment for options income strategies. Probably more like we saw a couple decades ago and less like what we've seen over the last 5 to 10 years.
So then you were mentioning, right, yield and total returns. How do you think an investor really should measure the success here? Is it yield? Is it, total return? Is it the mitigation of some of that volatility, a combination of them all?
It's actually a combination, in my view, of both yield and total return. So just for people who aren't as familiar, total returns is taking into account all of the distributions that an investment pays you over the course of time, plus the residual value of the investment at the end of the studied period. So if you have something that's paying you, call it 15, 20, we have some target 25s, 25% in distributions each year. If the underlying asset simply stays the same from one year to the next, you have a 25% total return, which is actually better than the equity market has averaged over the course of its history. So you have to focus for those things that pay distributions. You obviously have to include them. Not doing that would be like looking at the investment performance of a bond without factoring in the coupons that you got paid.
I'm curious, or I'm hoping that you can, because you were just mentioning, right, for those that don't know, because there are a lot of investors still that this is a fairly new category inside of the ETF wrapper. And so with some of these complexities, I think a lot of investors don't fully know or really understand what's going on under the hood. So talk to us a little bit about really what that trade is, or what that trade-off is that investors are making, when they go and when they buy one of these products.
Right. So the thing that I think is most important is that what's the first thing people do when they think about a security? They usually put in the ticker and they look at a price chart. But a price chart doesn't really tell you much when the investment is mostly about the distributions it makes. In other words, if you looked at a price chart of the equity that is in a car, if you put out a car loan, for example, one of the things, the balance is going to go down over time, but that doesn't mean the bank got a bad deal, right? So these are income-focused investments. So these are things that are going to be paying you quarterly, monthly. In some cases, they're going to be paying you weekly. So you want to factor all of that into your return calculations. Now, a lot of people need investments to give them yield. They might be depending on that to, pay their bills, or maybe they're retired. And so, capital appreciation is insufficient basically as an investor. So you need to make sure that you focus on both of those things. So what is going on in these funds is that, generally speaking, so we have both long and short funds. We have single stock strategies. We have diversified, thematic. But at its core, you have a position in the underlying equities, and then you sell options against that. The most basic option strategy that most people might be familiar with, you buy a stock, and then you sell covered calls against it. So when you do that, you have some equity participation, and then you have some participation because you're selling options premium. The trade-off is that because you sold an upside call, that stock can be called away from you at a higher price. So there is some limit to how much gains you can have from the equity. And then there's going to be, of course, the premium that you collect. Our strategies are a little bit different in the sense that, for the most part, they are selling covered call spreads. So we are making a little bit of a trade-off there as well, saying, okay, well, we want to mitigate the cap. So if some idiosyncratic event takes place and the stock goes up 20%, we want to make sure we get some of that participation. So by selling a call spread, we reduce the amount of options premium we get, but we increase the participation of the underlying equity in the event that you get a sharp spike.
So I was going to say, is that what you would say in response to the critics that say you're just trading away your upside with some of these strategies, pointing to essentially that YieldMax strategy where you are mitigating that trade-off on the upside?
Yeah, I mean, a really good example. So we have several strategies that include the most broadly held equity, NVIDIA, right? So that's held in some thematic funds. So we have two basically semiconductor chip funds that hold it. And then we have a couple single stock strategies that hold it. We have NVIDIA and we have INVIT, which is a 25 target strategy. Now, both of those, if you compare their performance to NVIDIA since the beginning of the fourth quarter, both of them on total return basis have actually outperformed the stock. And the reason they were able to do that was last year, in that tail end of the year, we had a couple really stellar results coming out of AMD, for example, out of NVIDIA, and those stocks were up 15 to 20% in about 7 sessions. When you have those kinds of moves and you sell a covered call that expires in a week, you're only going to get, a single-digit percentage. In our case, we were able to capture about 75 to 80% of the upside move in those instances, AMD and NVIDIA, when they had those sharp moves. If you have, a move in the middle, we may underperform a little bit on a standstill basis. So if the stock just tracks sideways, we'll do better. If the stock goes lower, we'll do better. And if it goes higher, we want to make sure that we're getting, call it 70 to 80% of the upside.
So the higher volatility, it gives you guys flexibility.
The higher volatility gives us higher options premiums. What does that mean? One of the things it means is that you can sell options that are farther away from the current stock price. So you get more equity participation. The other thing that it gives you is just more options premium. So you're also going to do better on a standstill basis. So all else equal, we like options premiums to be higher rather than lower because we sell them.
I'm curious to know, as I mentioned, the option strategies, that's not new, but putting them inside of the ETF wrapper is. And I'm curious to know what you think this sort of wrapper, the ETF wrapper, really gives to an investor when it comes to these strategies.
I think it really offers two critical things. One is that if you're selling options that expire every single week, logistically, that's going to be a challenge for most investors. Imagine you have a portfolio of 20 stocks. You're going to sell call spreads, which is 2 options pieces per stock. That's going to be 40 trades a week.
Right.
Just to get into it in the first place. And then you're going to be rolling them. That's a lot to manage. The other is tax efficiency, right? So that's really a critical thing. It can be difficult, I think, for investors at home to do trades like this and then manage it from a tax perspective. Anybody who's ever traded for themselves, and then at the end of the year, they get the 1099 from their broker, and they said, did I really trade that much? And you're sorting all of that out. It's a whole lot easier to buy one security and have somebody handle that for you.
So you mentioned earlier the single stock options income funds, but there's now been a shift from that to a more portfolio-based approach. What do you think is really driving that sort of shift?
So, the initial ones I think were for people who were very interested in running options income strategies against some of the most popularly traded stocks. So, if you look at the options volume for Nvidia, for Tesla, for Strategy, these things trade millions of contracts a day in many instances. So really it was investors telling us, look, we are interested in trading options on these, and it made sense for us to develop a strategy basically in a stock. That's essentially what you do. You get to buy the ETF and you have the whole thing done for you. But there are also people who are having a harder time. They don't want to choose stocks. They would much rather employ the strategy and then just say, I want equity exposure. So if you look at something like Biggie, which is our target 12, it's just the top 50 largest stocks by market cap. If you look at our recently launched Quad D, which is the Dow Jones 100 dividend index stocks, so this is going to be getting 50% qualified dividends, and then the rest is going to be options income. And that actually, I think, is a particularly interesting area to be, because the dividend payers, sort of the dividend aristocrat stocks, those tend to have a much lower multiple right now than the S&P does. So 21 times versus less than 15 probably on a forward basis, a lot cheaper. So if you're looking for a diversified, low-risk equity portfolio, that's going to take you in the direction of something like Quad D or Biggie. But then there's also the thematic stuff. I mean, semis are the hottest trade for the last 2 years for sure. Soxy and Chippy are examples where you're just getting into that semiconductor space.
What do you think the advantage is? And is it just, right, the ease for the investor of choosing that more, diversified portfolio approach as opposed to that, single high volatility name?
Well, I'll put it to you this way. I have two parents who are in their late 80s, and I encourage them to buy one of our funds. And, trading strategy, trading Nvidia, this is not for them, right? They're retirees. They depend on the income. So they're just looking for modest distributions, combination of dividends and options premiums. They don't want to see a lot of volatility. Some of these are stocks that they already held. For example, Kimberly-Clark is one of my mom's favorite stocks. She's had it as long as I can remember. We used to get care packages of toilet paper at Christmas.
Products,
yeah, that you get it at Christmas. You could just put it on, because she was a registered holder of the shares. So, something like a Quad D would be suitable for somebody like that. The people who are looking at single stock strategies, they already know they either want to be long or short that stock, and they're just looking for somebody else to handle the options overlay piece.
I'm curious to know where you really see these fitting inside of a portfolio.
The single stock ones are for people who have a strategic, tactical view on the underlying. So if you're just a broad-based investor and maybe you have a view on semis, you can do something like that. You have a view on AI or robotics, then you can do thematic investing in that space, and you can choose a more broad-based ETF. And if you're just looking for equity exposure with an overlay, then it's definitely going to be something more like a Biggie or a Quad D, something like that.
So you think that for some investors, this could really even be a long-term hold instead of just a tactical tool really meant to be deployed only in a volatile
Biggie
environment?
and Quad D are long-term investment vehicles. The single stocks, those are tactical, strategic trading products for people who are constructing their own portfolios.
All right, my co-chief strategist at YieldMax ETFS, thank you so much for joining us today.
Thank you for having me.
And thank you for tuning in to the ETF Show.